What if everything you've been told about markets and inflation is incomplete? What if inflation isn't just the result of supply shortages, greedy corporations, or reckless spending, but a feature of the financial system itself? A silent mechanism that transfers wealth slowly, legally, and almost invisibly. Here's the mystery. Why do markets soar during times of money printing, yet everyday people feel poorer? Why does inflation keep returning no matter how many times it's defeated? And why do the same financial patterns repeat across decades, countries, and crises? Tonight, we're not just talking about prices going up. We're uncovering the hidden story of markets, inflation, and financial trends, how they were born, how they rose, where they broke, and why the fixes keep failing. The answers are uncomfortable, and once you see the pattern, you can't unsee it. Setting the stage. The financial machine, 1:30 to 5 o'clock. To understand inflation, we need to rewind, not years, but centuries. Modern markets didn't evolve naturally. They were engineered. At the center of the system sits money, not as cash, but as credit. Banks don't just lend existing money. They create it. Governments don't simply collect taxes. They borrow future productivity. Central banks don't just stabilize economies. They manage confidence. This structure accelerated after the 20th century's biggest turning points. World Wars, the Great Depression, the end of the gold standard. Once money was untethered from hard limits, something changed forever. Markets became dependent on liquidity. Growth became dependent on debt. Stability became dependent on intervention. At first, it worked beautifully. But buried inside the system was a time bomb, one that would only reveal itself decades later. Origins, the birth of modern inflation. 5 o'clock to 9 o'clock. Inflation wasn't always normal. For much of history, prices were relatively stable over long periods. Inflation spikes usually followed wars, plagues, or disasters and then subsided. That changed when governments discovered something powerful. If you control money creation, you can delay pain. Instead of raising taxes, governments borrowed. Instead of defaulting, they printed. Instead of allowing recessions to reset the system, they softened them. This is where cause and effect begins. More money entered the system. Asset prices rose, first stocks, real estate, bonds. Wages lagged behind, living costs crept upward slowly. Inflation wasn't explosive, it was gradual. And because it was gradual, most people didn't notice. But markets noticed. Rise booms, bull markets, and illusions, 9 o'clock to 14 o'clock. As liquidity increased, markets entered an era of historic growth. Stocks reached new highs, housing prices exploded. Financial products multiplied. Every cycle followed a familiar pattern. Easy money encouraged risk. Rising prices created confidence. Confidence attracted speculation. Speculation inflated bubbles. Each time, the narrative was different: technology, globalization, housing, innovation. But the mechanism was always the same. Inflation didn't show up immediately in consumer prices. It showed up first in assets. Those who owned assets got richer. Those who relied on wages fell behind. The gap widened quietly until something snapped. Breaking point, when inflation can't be hidden. 14 o'clock to 19 o'clock. Every system has limits. Eventually, inflation escaped asset markets and hit daily life. Food, energy, rent, transportation. Once inflation reaches essentials, it becomes political and dangerous. Central banks faced a dilemma: raise interest rates and crash markets, or keep printing and risk runaway inflation. History shows what happens next. Rates rise. Debt becomes expensive. Companies struggle. Markets shake. What once looked like prosperity is revealed as fragility. The breaking point isn't sudden, it's delayed. Years of easy money create a moment where every option hurts. Fallout: who really pays the price? 19 o'clock to 23 o'clock. Inflation doesn't hurt everyone equally. Savers lose purchasing power. Workers see wages fall behind prices. Small businesses face rising costs. But debtors? Large institutions? Governments? They often benefit. Inflation reduces the real value of debt. Assets recover faster than incomes. Bailouts stabilize the top while losses spread below. This isn't accidental, it's structural, and once people sense it, trust erodes. That's when financial trends shift from optimism to fear. Failed fixes. Why solutions don't last. 23 o'clock to 27 minutes and 0 seconds. Every crisis brings promises of reform. New regulations. Stricter oversight. Better models. Yet inflation returns. Why? Because fixes treat symptoms, not causes. The system still relies on debt-driven growth. Markets still expect intervention. Governments still spend beyond limits. Each fix buys time but increases the scale of the next problem. And so the cycle repeats. Modern parallels. Patterns repeating today. 27 minutes and 0 seconds to 31 minutes and 0 seconds. Look around. Rising living costs. Asset bubbles. Debt at historic levels. Public frustration. Different decade. Same structure. Technology changes. Currencies evolve. But human incentives don't. Whenever money becomes easier than productivity, inflation follows. Whenever markets depend on rescue, risk multiplies. The pattern isn't hidden, it's ignored. Conclusion: 3 takeaways, 31 minutes and 0 seconds to 34 minutes and 0 seconds. So what does this all mean? Takeaway number 1. Inflation is not an accident. It's a byproduct of how modern markets are built. Takeaway number 2. Markets don't reflect reality in real time. They reflect liquidity first, consequences later. Takeaway number 3. Every cycle feels unique but follows the same cause and effect chain. Here's the warning. If we continue treating inflation as a temporary problem instead of a structural one, the cycles will grow more extreme and the fallout more unequal. The open question is this: will the system change before confidence breaks completely? Or will the next crisis be larger than anything before it? That's not a question for economists alone, it's one that affects everyone who uses money. If this video helped you see the bigger picture, like, subscribe, and share it with someone who still thinks inflation is just prices going up, because once you understand the system, you stop being surprised by the outcome. And that awareness might be the most valuable asset of all.